Welcome to Bar Charts Market on Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. Was this the week's meltdown historical in nature? Maybe better yet, the question is should we use this as a buy the dip opportunity, or is this the bend at the end? The dollar's strength continues to astound experts, but not us at MOC. We've been on top of this rally for quite some time. We'll look at what has been fueling the strength and how far it could run. I want to share a trade idea with you that I'm planning, and I also want to review one that came to fruition. Plus your questions and a holiday salutation. And to help me with today's show, as always, my co-host and Santa's little helper, Thomas. How you doing, buddy?
I'm good, buddy. How are you? What a nutty week in the markets, huh?
Oh my gosh. Setting up for next week's Santa Claus rally, that's for sure, right?
Oh, I think everybody's got their fingers crossed for that at this point, John. So just a reminder for everyone watching directly on our website, if you want to ask a question, just click ask a question at the top right. You'll see it in orange. And then if you're watching on YouTube, just go ahead and ask those questions directly in the chat, and John and I will get to as many as possible. All right, so this has been an absolutely wild week for the markets, John. Not something we would normally see in December. People generally expect tranquility and calmness. And while we could throw a dart at the board to pick one of the many wacky things we've seen happen this week, John, we're going to start with a historical losing streak for America's oldest stock market index. And that, of course, is the Dow Jones Industrials, which up until yesterday, John, had a 10-day losing streak, the longest in half a century. So people know that. They can read a chart. But, John, we turn to you for your sage advice. Is this a buy the dip opportunity that everyone is always begging for, or is something more sinister beginning to appear in the markets?
Yeah, well, I think you put out a great tweet about this, that this hasn't happened in 50 years. So we have to think about this in terms of not only as a historical, but as an outlier of what has happened in the market. So yeah, I think this is something that we have to process. So the question comes is, you know, we've been trained as traders or investors that the market always goes higher, right? And that anytime the market sell off, this is an opportunity or a buying opportunity or buy the dip opportunity. But if we look at this sell off, some folks might say, well, this event occurred because of maybe just one stock, right? I think you mentioned this to us in our pre-session, right?
Yeah, absolutely. So obviously United Health, some of you may not know, that is a stock that is part of the Dow 30. And United Health has obviously been in the news for some unfortunate reasons, John, but the stock price has really taken a dump, and that has been hurting the Dow Jones Industrials, in my opinion.
Yeah, so for Dow Jones, if you're not familiar with this, is what is called a price-weighted index. In other words, the price of the stock is added into the index. And so a large price stock, if it has a big movement to the downside, will have a major or greater impact on the index itself. Now, we have to put this in context. The Dow fell something like 2,500 points. Yeah, the United Healthcare has fallen, but it probably only represented about 700 to 800 points. So it's not just a one stock phenomenon; it's multiple stocks, and then maybe it's multiple stocks that are related to the Dow. But I just want to kind of give you a little bit of a historical before we move to the potential future. So here is the Dow Industrial, and I want to show you that how historical this was. This sell-off that we saw is comparable to what happened in late of 1974. Now, in the 70s, we were a decade where the market kind of went up and down, but basically overall was unchanged for most of the decade. But what I think is a little bit different, Thomas, this time is this 15-day sell-off, this 10-day sell-off, that the record that we just beat came at the end of an already dismal year, where this one that we're getting now is come after the market has made an all-time high. So is this a change in trend? Now, again, look at this in terms of historical. We did get a major sell-off, which created that historical event. And yes, the market did eventually bounce from here, but it took months before it bounced from it. And, we definitely can see a level where price would have to break out of that created this potential rally. Now, I want to give you this big picture perspective on this, how crazy the 70s were, where we were having 50, 60, 70% point swings, throughout the year. So this did eventually lead to a significant rally in the market, but this was a rally from a low, not a rally from a high. So this is the point I was making to Thomas was, this is not just isolated to the Dow. So here I have the S&P sectors, and I'm going to go to my flip charts. Now we know that technology, discretionaries, and communication services have been the outliers or the ones that have been driving the market higher. And we know that those ones are cap weighted, which are weighted towards our Magnificent Seven. And the Mag Sevens are the ones that led us into this year on this rally, and something that we talked about a couple of weeks ago, we thought they would lead us out of this year as money managers try to enhance their performance. And that's exactly what we are seeing. So here you can see even the technology sector that had maybe a little bit, let's go to just a regular chart here. It had a little bit of a correction, right? And over the last couple of days, and we did have a nice snap back here. So the question now becomes, is this a change in trend, or is this a buying opportunity? And so I want you to keep that in mind as we go through. So yeah, I think this could be a good potential buying. And here's that communications sector, right? Again, a little bit of a sell-off, but a nice little bounce back. But this trend certainly looks like it's still in control. But let's go beyond those sectors that we know that are already been doing well. But let's look at the energy sector, right? That does not look too healthy to me. Does that look healthy to you, Thomas? Not really, right?
That looks pretty horrific, honestly, John.
I mean, here's industrials. So there's a theory about when trend changes, we want to look for two things. And the two things we want to look for is what is called a change in character. Now, what does change in character mean? Well, that means that, what represents an uptrend? An uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows. And so what we're seeing is a change in character. We had a bit of a higher high, but we're now making a lower low. The second part of a trend change is something called break of structure. In other words, when our change of character breaks the character of the previous trend. And so, if we break a lower or higher low, that would be a sign that we are starting to begin a downtrend. Now, we have bounced here. We have bounced right where we should. But you look at here. Here's materials. Right? Here's that discretionaries. Here's healthcare, right? Break of structure, change of character, break of structure, downtrend. Staples, right there, very close. Real estate, again, low, not making new highs, change of character, now break of structure. Utilities, now breaking a structure. So if we're going to buy a dip, we need to have a certain set of rules, and setting a set of rules in terms of how we manage risk. Now, I always like to look at markets at different time frames. I think higher time frames can tell us a story. Now, if we go back to, let's say, the Dow, and we go back to the Dow today, let's go back to the Dow today. right? Where could I set my risk, or how could I determine a buying opportunity? So, I do have this rule, and it's called the three candle drop, and it's a unique candle formation that is rare, but when you see it, it usually is a good setup. It usually is a good buy setup, but there's still rules of risk to it, and it says that basically is you have to wait for the market to stop falling, right? You're not going to try to catch a falling knife. You want the knife to hit the floor. You need a green candle to close, and then that is going to set your risk. Now you'll get a buy signal when the market on the next candle gets above this green candle, and then you would set your risk on the low of the combination of one or two candles that set this low in place. So that would be a way how we could manage risk if we thought this was a buying opportunity. But this is at the daily level, and I want to show you what this looks like at the weekly level. And if I go to the weekly level, there is that candle formation that I've talked about multiple times in our shows. This is that three candle drop, this cascading sell off. And usually the last candle is more of a capitulation. So that's a good sign for us. But again, let's look at our watch list. Let's look at our sectors. And what we'll notice is we get a lot of three candle drops. Here's real estate, right? The last candle is the largest candle. That's what we want to see. Here is staples, right? The last candle is the largest candle. So if we're doing this and we're going to manage our risk, what we have to do here is, yes, we saw a bounce today, but I think that was more about options expiration than it was about a potential buying opportunity. So here's three candles. So now what we need to do is we need to wait for a weekly candle to turn green as a buying opportunity develops, and still need that next candle to break above that green candle. So we're not there yet. So in other words, Thomas, is we need next week's Santa Claus rally to make a green candle. And then the buy signal is not going to come until the first of the year. So if I'm a long-term investor, yes, I think this sell-off is a buying opportunity, but I need to manage risk, and I need to look for that sequence of events that is going to give me a higher confidence and a higher probability that the market is at a buying opportunity. At the same time, I want to make sure that the stocks that I am looking at are those that are on my want list, that we are just seeing maybe a change in character and certainly not a break in structure. Does that make sense to you, my friend?
It does. And I think that's a ton of great information, John. The one part that really resonates with me is having, spending the time now to build your grocery list, right? Like, identify the stocks that you've maybe been wanting to establish a position in, but just haven't felt the opportunity was right. Now, maybe with the sell-off, maybe those come back into play for an individual. And the other thing too is, and just for full disclosure, John and I were having a heated discussion about this in our planning, because I'm very apprehensive to get off the choo-choo bullish train because it's just worked so well for me. And I look at the S&P 500. There was a 3-week period in July and August where it fell about 500 points. So that was about a 9.5% drop in the index. So a person could have looked at that and thought, you know what, I do feel like there might be something going on here. I'm gonna refrain from buying. As it turned out, that was the last great buying opportunity we've had in the market. So it's a tricky thing, John. It's a kind of a very thin needle that we're trying to thread here.
Yeah, I agree with you there. I mean, we have to look at history in terms of this buying dips opportunity. But we also have to respect that we are coming into the next year where a lot of things are going to change, right? We're going to get a new administration. We don't know what kind of fiscal policies, what kind of monetary policies. Certainly the Fed has changed their thoughts. So there's a lot of change that is going to come next year. And the market doesn't like change. Now, it doesn't mean that 2 or 3 or 5 or 10 years when we won't see prices higher from here, but it might mean that we might have a cycle where we go through, let's say, a change of leadership, change in those stocks that were outperforming will maybe underperform in the next year. I don't know exactly what is going to happen. I certainly like some buying opportunities. I'm thinking if we're going to have more inflation, which is what the market is kind of telling us, and we're going to next thing we're going to look at that. I want to look for those type of inflation stocks, and that would be, let's say, if I was going to go into, the different sectors. I think that would be in the industrials and the materials. I think those sectors will do well in more of an inflationary environment, even the energy sector. But the problem with them, to me, in terms of their trends, right, is that the energy to me feels like this is a major change in character, and this has broken structure. So I need to see a new uptrend develop. The materials to me, I think, again, this to me feels like more like a downtrend than it is an uptrend. This doesn't mean the market can't have a rally from one of these lows, these new lower lows, but I still want to see the market recapture some of these, some other metrics. And one of the ones that I like as an investor is I like to see my stocks above the 50-day moving average. So that will be one of the keys for me moving forward into. And again, I'm not even going to look at buying anything over the next 10 days or so. I'm going to wait until the first week of January, and then I'm going to say, okay, did I get that green candle close, and then did I recapture some of those metrics? And one of the ones I would be looking for is that 50-day moving average.
Okay, great. A ton of awesome information there, so people can kind of follow along and look to see how it plays out over the next few weeks.
Yeah.
All right. All hail the mighty King Dollar, John, because it is truly number one in the world. Now, I'm heading overseas at the very end of this month, so I'm actually celebrating secretly or not so secretly over here, John, but many around the world are not. Foreign currencies are just crumbling, left and right against the dollar. The Brazilian real, the Indian rupee, the Korean won, the Russian ruble, Canadian dollar, the Australian dollar. You don't often see that one crumbling, John. What is going on? This is something that a lot of people are watching. The dollar index, which just put in, I think, a 25-month high. When is this strength in the dollar going to end? So some folks around, our friends around the world, can have a little bit of time to relax.
Well, we talk about trends, and so currency trends tend to be very long and extended, and so we're still in this uptrend, no matter how you slice it, in terms of big picture, right? Again, this is a weekly chart. Now, we've been on top of this one. We've been talking about that we believed that the dollar was going to break out of a range that we had been stuck in for quite some time. And that range we identified was around 106 on the down upside and 100 on the downside. And we did break above it. We consolidated, which is a great sign of strength. You come back to an area of resistance that you broke out, and then hold that, and then break out above it. So I think this is a continuation of what we've already seen in this macro trend. Now, why does the dollar strengthen? Or what is the reason why, if we look at two currencies, why does one currency do better than the other? Well, in Forex, it's called the carry trade, the difference between the overnight interest rates. So the U.S. interest rate market is one of the highest in the world, but it's also one of the safest markets in terms of interest rates, right? U.S. Treasuries are considered the premier of treasuries or debt instruments. And the other way or reason why currencies one is stronger than the other is called capital flow. And capital flows into economies that are doing well, and that raises that country's currency. And so I think this is also a true indication that the United States economy is one of the best economies. And you said it right? It's not just one or two. It's not the dollar versus the euro or the dollar versus the yen. This is dollar versus everybody, which is telling us that we have the strongest economy in the global market right now. So I think the market is showing that, and we're seeing that in the dollar. So where could we go? Well, let's look at this. There is really no resistance now until we get, you know, I think the number is somewhere around 109, right? There it is, 109.5. And, I think we could talk about somewhere's right about here. So that's 110. So I think there's a lot of room for the dollar to rally. Now, why would the dollar rally? Well, first of all, our stock market is making all-time highs. Now, there are other countries' stocks that are doing well, but maybe their economies aren't. But the other aspect is the interest rates, right? And, a Fed cut our short-term rate, but what happened to the long-term rate? The long-term rate went up, and this is something that we've been looking at for quite some time, that we have broken this historical downtrend in rates. And, just as a recent, the last couple weeks or months, we've kind of broken out of this, this pennant. Now, Thomas, you made a great point to me in terms of our production meeting. You said something to me about technical analysis on something which is like the interest rate, right?
Well, exactly. So I would put more faith, John, if you were doing TA on, let's say, Treasury bonds. But since the yield is a derivative of something else, I sort of wonder how much value should somebody put in this?
Yeah, but I think we can look at this in terms of where interest rates could go. And certainly you can see it based on the 10-year note, we're looking at around 4.9% to about 5.2%. And again, that would be based off some historical recent highs and lows. But I said to you, well, this is the interest rate. But if we look at something that is actually traded, right, or that has interest rate relationship, and that would be the TLT, this is the 20-year bond, and we look at the same dynamics. Now, remember, the bond price is an inverse to the yield. So as the yield goes up, price goes down. And we look at this as in more of a technical analysis. And I agree with you. The yield, I probably would only look at very high time, for, technical analysis. I certainly wouldn't be looking at short-term patterns. But on this one, I think we can look at it. And what to me, it seems like to me is this looks like a double top where now we're about to break the neckline. And if we do break that neckline, well, the TLT could fall somewhere down, around the 85 to 84 level. And that would equate to about a 5% yield on the 10-year note. Now, the question I think we need to ask ourselves is, if we come March or so next year and the stock market is still floundering around near all-time highs and we're now looking at 5% yields, what would that do to the stock market? Or is that the catalyst, is the change in character of our uptrend? So I think that's really what we need to focus on come next year.
So, John, do you think if rates got up to 5%, I mean, do you think that would cause a severe roadblock for equities? And
I think it would. Yeah, because then you're going to think about asset managers, right? Will they be more willing to take the risk-free 5% yield where, they said we could look at, let's say, what's going on in U.S. economy. Now, if the U.S. economy is doing well, and, technology is still one of the strongest sectors and all that, then I think they're probably going to stay with the stock market, right? Because there's probably better beta or alpha in that. But what happens if the new administration comes in and brings a whole new wave of change? And that could be, tariffs, right? What would tariffs do? Well, that restricts global trade. That restricts economies. And I think that would be, kind of a red flag for the market. And that might also hyperinflate prices, inflation, right? And inflation means that, if I'm an investor in inflation assets, I'm going to demand a higher yield. And that means that I'm not going to pay as much for a treasury note. And so the price of treasuries will fall and the yields will go up.
All right, perfect, John. Well said. All right, so we've had a couple of great segments, John, but listen, we all know why everybody is here. It's for everybody's favorite time of the week, and that is John Rowland's pick of the week. So, John, I hope you've got a really, really good one for us so that we can celebrate and forget about the misery we've seen in the markets the past couple of weeks.
Well, I don't say it's misery. I would say that, it's just, part of the market cycle, and it's time to, again, it's time of the year too. I think this time of the year you do see some kind of crazy volatility. Last week you talked about that we thought the market was going to back off. I certainly didn't think it was going to back off as far as it did, but we did talk about that. But, a lot of times when I try to develop an idea or a thread, I look at a news story and then I kind of like say, well, can that take me to a potential trading opportunity? So, recently I read this article in the Wall Street Journal that says your junk is needed for a new electric air. And basically in the article, it basically said that a Canadian scrap company that scraps copper is reaching out to U.S. landfills and wants to buy, their computer components or this junk that has, copper in it, and they're looking for scrap copper. But that kind of got me thinking is that, I know from personal experience that a lot of these companies, these waste management companies, are in methane capturing. And so that is an asset that they can get from some landfills. So and then there's other things, lithium, right? And recycling batteries. So I'm like, wow, this is pretty interesting that literally our junk is actually turning into a potential profit maker and not just a depreciating asset. So I went into waste management because that's the first one I was thinking of. I was like, okay, waste management. Now again, look at this chart. To me, waste management, right? This definitely looks like a stock that is in a downtrend, right? And again, break of structure, a change of character, break of structure. But, maybe there is, some opportunities in this sector. So one of the things you can do is go to under price preview overview, and you can look at down here which sectors that falls into. But, I like to look at these 6, which is what is called standardized industry concentrations or something to that, I think, anyway they call them. And what this really does is it shows you where it really is their peers. And, I went in here, and again, we'll sort this by weighted alpha. Now, if you're not familiar with weighted alpha is a way to, a measuring stick to see how much a stock has performed over a 52-week period, and it's weighted heavier towards the last, month or so. So, I went in here and I said, well, okay, waste management is, doesn't have a great alpha, but certainly there are other companies inside of this sector, this industry group that might be taking advantage of this idea of, who are these copper companies or smelters reaching out to? So, you got to do your own homework on this one. But, there's 2 of them that, stand out to me. And when I was doing my homework, and that was Republic Services and Casella. Both of these are active where their landfills are actively recycling. And as a matter of fact, Republic Services is quoted as the second highest recycler. So let's go look at their charts, okay? Now, again, you're going to have to do your homework, and this is not a recommendation. I'm just kind of showing you how I'm developing a thought. So here, again, is this a change in character, right? And has it broken structure? So certainly to me, it looks like that is what is happening with Republic Services. But if we held the 200-day moving average and then recaptured the 50, right? Again, this is not a buy today. I'm talking about looking at this over the next, 3 to 4 months. This might be one of those ones that I'd be looking at. And again, here's Casella. Again, this one looks a lot more healthier to me. In other words, this is a nice uptrend, right? So this is maybe a slight change of character, but it's certainly not a break of structure. and the fact that this one is now holding right around its 50-day moving average. So it is below it, but it is still above the 200-day. And you can notice that, remember gaps. We talk about gaps. And I love the fact that the market has come back close to this gap. So again, to me, I know what my risk is here. It's either this gap fill or the 200-day moving average. But I probably want to see this stock recapture the 50-day moving average, or even more likely, I really want to see it take out these highs. Now, this might not be an investment, but I certainly could play the momentum on this one if it does turn around. So that would be what I wanted to kind of do, was show you what we're seeing in the broader market, and then show you kind of how this thread idea is like, well, maybe there is opportunity in the junk that we throw away, and which of the stocks that are in that class that still look decent compared to what we look at in terms of trend, character, and structure.
So, John, since we're on the topic of picks of the week, we actually did get a question. They were hoping for a follow-up look at something you talked about a while ago, which was Starbucks. And I just wanted to know if you have any more thoughts on Starbucks and what its trading looks like, because it doesn't look too good.
Well, you remember we looked at this as we wanted to buy a put spread. I said that there was a seasonality that was coming into Starbucks, that in January, the seasonality is negative. But it tends to have a little bit of strong seasonality in November, and then in December and January has a negative seasonality. So, I said that, we're fighting a trend. This was a contra trend trade. We're fighting this little upsloping trend, but we're at the high end of the channel, and I thought this would be a great low risk trade, contra trend trade. And, I said, I was like, I think what we did on this one, well, I know what I did on it, is I built a position where I think my average trade was, I spent about $1.50 for this spread. Now I used the 97.50.90 strike, and wow, it really worked out well for me. Matter of fact, I was just, before I came on, I went and looked at, a couple of my resting orders, and it basically, I got about 85% or 80% of this spread. So I was very happy with this trade to ring the register and take this one home. Now, the fact is that, Thomas, we're not even into January yet. So there might still be a little bit more meat on the bone on this one. But I was very happy to get about a 3.5, 4 bagger around this one, if you think about it in options. So I just want to let you guys know that I put this trade on and I've taken this trade off. I'm probably going to look for another entry into this trade, because now what I see here is we have broken structure here, and we have a lot of empty space here. So I wouldn't be surprised in January that we might continue this trend or continue to trade sideways to the downside on this one. So I'm going to watch this one coming in January, but I just wanted to let you know that this trade, as we set it up, and the risk that we took, $1.50 risk in the options for a potential $7 potential spread profit, worked out. It worked out really nicely for me.
So, John, one thing we've talked about quite a bit in the past, though not on today's show, is crypto. We've talked about this idea of an alt season. We got a question sort of asking us on our follow-up thoughts, and if we've changed our mind because of what Powell said at FOMC. Yeah, I think so. I think there's definitely a good chance that altcoin season has been delayed. So as a reminder, we were looking for two main things, John. We were looking for the Federal Reserve to begin quantitative easing. That didn't happen. They are continuing with their QT. That is not favorable to altcoins. The second thing was we identified the ETH BTC ratio, John, and we said that although January and February kind of marks the beginning generally of an uptrend in the post-halving year. However, that ETH BTC ratio has fallen off again, John. So we talked about maybe going over the 50-day moving average, and it didn't. We talked about getting a couple weekly closes above it, and it didn't. It just fell off. And if you look at altcoins right now, it's been a rough week. Even something like Solana, John, which is kind of the coin that people talk about the most after Bitcoin and Ethereum, that one has just gotten pounded this week. So I just have to tell people to be patient. I know it's frustrating. Everybody's waiting to get rich from their altcoins, but it's just not ready right now, John.
Well, I think that's wise advice. Again, I think is the theme here is the same, right? You need certain types of rules before you jump in, and you need to make sure you know how to manage your risk to tell you that you're wrong, right?
So if anybody's thinking about we talked about buying the dip in stocks, that's a heck of a lot safer than currently buying the dip in your favorite altcoins. Just realize they can go much, much further down. And if you look at this ETH BTC, John, I mean, if that takes out the low point that we saw towards the end of November, I mean, it's anybody's guess what that could go to and
Right.
what that could do to other altcoins. So just
Right.
if you're out there trading these guys, be careful with this stuff.
Fair enough advice. I think good advice and something
All
that.
right.
All right. So what kind of questions we got today? I have a feeling it's going to be a little late today, right? Holiday parties and all.
Yeah. Well, we got a good one here, John. I'm interested in your thoughts as well on silver. What's going on with silver, and do you think maybe a bottom is going to be forming anytime soon?
Well, I think you have to think of silver in terms of gold, right? I like silver when the market when the precious metals rallies. I like silver because I think it has a higher beta than gold. So I think on up days, I think it's better to own silver than it is gold. But I think on the downside, gold's a little bit more static and silver is a little bit more volatile. I mean, it is one of the nicknames of it is called the Widowmaker. But to me, I think more about what is problematic with silver is the dollar. And, the strength of the dollar is going to continue to be a major headwind for silver. So, again, we're kind of anticipating the dollar on a weekly basis still has room to run. So in this case, let's look at this in terms of our trend. Well, we're still in an uptrend. We're still making higher highs and higher lows. Have we made a new low? I don't know. I think maybe we could fall a little bit lower on a weekly basis. But I would be afraid if we broke this structure, especially with a dollar that got up to like 110 or so, then we might have to fall all the way back down into this area. Now, this is a weekly contract specific. Let's look at the weekly nearby. So I think you can see a little bit better here where I would not be surprised that silver falls close to maybe not this low, but somewhere around this low. And again, let's kind of do this multiple time frame analysis. So here's a weekly candle. Then we go down to the daily candle, and we look for that blue line, and do we see any structure around here, around that blue line? And there's some nice little bottom here. Now the question is, are we near this? Well, no, we're not. So, but we are getting close. So to me, let's see if we fall into this zone here, hold, the dollar reverses, and then I would be looking for a strength in silver or in the precious metals as the dollar reverses. So that would be how I would tackle that one.
John, we got a question about, obviously the markets are bright green today, and they want to know how you identify sectors that are performing the best.
Well, we have a couple ways you can do that. You can go in here as stock market sectors. And here it is this tells you on today which ones are the ones that are the outperformers. And you can see, like you said, it was a green candle day for all 11 of the sectors, but you can look and see, let's say, over the last 5 days, and then you get a different story where we get everybody's, down. Now, this is kind of interesting. If we look at this, technology is the best of the worst, but utility is right behind it. So here we have growth and expansion and all the good things about the stock market, and then utilities, on the other hand, which is more of safe haven. So the market is kind of acting a little psycho for us, even though it was down 1.5%. So, but this is a great place to start if you're looking for that. So, and again, you can look at this over multiple time frames.
So we got a question, and the question is it not a risk entering the market pre-Trump? Now, I think what they're trying to ask, John, is we've already seen sort of this boost from Trump winning, and now in a month or so, right, we're going to be faced with the reality that a new administration is coming. Some ideas that the market likes, some ideas that the market doesn't like. Could this sort of pre-Trump boost that we've seen sort of falter off and give way to reality? What do you think, John?
Yeah, I think is a lot of the, there's a lot of adages, buy the rumor, sell the news, right? I'm then, then the bloom is off the rose, and all that excitement, that retail excitement that drove the market up. I mean, I'm going to ask you a question. Is I think you set out a tweet a couple weeks ago where November was the largest inflow by retail investors in the history of the stock market, or something like that, wasn't it?
Yes, that was one, and I also there's been multiple things, John. I mean, just the other day I saw that fund managers had their lowest allocation to cash in history. So you see something like that, and you ask yourself, okay, well then who's going to buy the dip?
Well, that's kind of my point, right? Everybody bought the market, right? And now we're all looking around going, are you going to buy it? Are you going to? I don't got any more money. Are you going to buy it? I'm not going to buy it. So, right, that's where I think we're kind of at. I think that's why I think we need to wait until next year to make that decision if we're going to invest in the market. And again, that might not come until after the inauguration day, which is what, January 20th, January 21st. Because he says he's going to do a lot of things on day one. When we get a better picture of what his plans are based on his actions that he does in that first week in office.
So, John, we got a question about, obviously Wednesday was not a good day for the markets. It was actually quite painful. And the question is for you, John, is when you see something like that happen, what are you doing with your portfolio? How are you preparing for life after that big down move? Are you liquidating positions? Are you looking to add things?
No,
What's your style?
Yeah, I think coming into, remember then we talked about this last week. We said we thought the market was going to come off because of OpEx this week, and that I said to you, watch what happens on Wednesday. Wednesday, I think, will be the key for you as what was going to happen during the week. So going into Wednesday, and I kind of had this feeling that this is what was going to happen. And so, I still, think about it. The one couple of trades that I showed you, or one trade I showed you, that was a bearish trade in an uptrending market, right? So there are opportunities. You just got to pick your spots and manage your risk. The other one, if you want to look at, was the XHB was one that we talked about, the interest rate sensitiveness to the market, and that one has worked out as well. Two bearish scenarios, trades that in an uptrending market. So I looked at a couple of my winning stocks. I sold some calls to make sure that I kind of protect myself, or at least generate a little bit of income if the price of the stocks fell. And some of the ones that I had done really well, I used that income to buy some puts, some puts to protect myself. So, and that trade would be a wash, right? So my puts protect me to the downside against the calls that I sold. So, even though some of those stocks fell off, now they're all back up today. So that was a good thing. But again, that mentality of using options to protect your position is always something I'm always looking at in terms of timing. Now, again, Warren Buffett, I love his analogies, right? Is You got to be fearful when everybody's greedy and greedy when everybody's fearful. So the time to buy puts was not, on Wednesday when the VIX jumped, 40%. It would have been in prior to that. But when the VIX got up to, let's say, 40% this week, and we had that major sell-off, over the next day or so. Well, if you were looking to buy a dip, well, that would have been a great way to get into the market, right? By selling volatility, in other words, selling puts that are out of the money in stocks that you were willing to buy, right? And that would be a great way to get into a trade. Now, you're not committing to that trade, but you're certainly having an opportunity to profit if that stock rallies. And then you could wait and see if you get those confirmational notes that you want to allow you to invest in that stock.
John, we got a question on if there's still fuel in the tank for Palantir, which is PLTR. And looking at the chart today, heck yeah, there is. I mean, like it's just absolutely, it's blasted. It's almost back at its all-time high. I've got an interest. I'll turn to you for your thoughts in a second, John. I've got an interesting strategy approach to what I did here. There's occasionally names, John, that are just hated names because you don't have a position and you're just watching it go up and up and up and up and up every single day. So when it got into the 70s about a week ago, I just said, forget it, screw it. I'm going to jump in here. I'm going to buy it. I know nothing about the stock. I know nothing about the prospects, but I'm just tired of watching it go up every day, John. I did that with Nvidia, quite a while ago, and that one worked out.
Right.
So, that's what I did here.
Yeah, that wouldn't be my strategy. It's certainly one of the mistakes that a lot of novices make. But hey, the market rewards risk taking though too sometimes. I just think this is kind of that. We talked about the next wave of the AI mania. We went from the chips, and then we went to the energy power sourcing the data centers, and now there's this narrative that it's really what are the first companies that are going to start to really profit from the expansion of AI, and that is the software, right? And we've actually looked at this, but if we look in prepackaged software and we look at weighted alpha, look at how many of these stocks have a huge positive weighted alpha. And you can see Palantir is right there at the top. So, what your style was, maybe I might be a little suspect of it, but in retrospect, what you were doing was you were buying one of the best performing stocks in one of the best performing sectors. And that is certainly not a bad recipe for success.
And I think that's a great point. Like what you just said, John, I didn't even look at what you just said, but sometimes the market is telling you something, right? When you look at price action. So that's was sort of what I followed,
Yeah, I think that's, again, price tells us a lot, right? So, at some point we got to say, well, is Palantir making a certain amount of revenue or income that validates that price? Eventually that will come to an end, but for right now, the momentum certainly is, this is one of the outperformers in a sector that has been outperforming all of other sectors.
We have one more, John, and then we'll wrap up the show with this. It's from our buddy Esther, who comes every week. Hope you're doing well, Esther. John, she wants to know, when we talk about buy the dip, are we talking about long-term investors, swing traders, or some combination of everybody who wants a position?
Yes. Esther,
yes to all three.
Buying the dip means that if you are in an uptrend, you're waiting for the market to have what is called a drawback. Now, what you want to do is you want to wait for that drawback to find a level of support that you feel is significant. You can either wait for a price to touch that support, or you wait for it to go into that support, or you wait for it to go in the support and then out of the support. So this is called a limit entry, a zonal entry, or what we call a confirmational entry. And you could do a buy a dip in all time frames. It doesn't mean if you're an investor, I'm probably looking at weekly and monthly levels of support. If I'm a swing trader, I'm probably looking at daily, maybe 4-hour time frames. And if I'm a day trader, go into a bar charts templates and look at that 13 EMA template, and I would be buying dips at the pivot support levels for a zonal entry, or I would be buying breakouts of zones when we get through the 13 intraday EMA.
All right, so that wraps up our Q&A. There were a few questions that are more website related, so guys, look for an email from support. They will be getting in touch with you probably this afternoon. So, John, that wraps up today's show. It wraps up our last show of 2024. And listen, I just want to, from myself, I just want to give a thank you to everybody. We've seen a big spike in our audience this year, John, which is awesome. This is our third year of doing this. So again, really thank you guys to everybody for using Bar Chart, for coming to check out our Market on Close show. I know John and I are very appreciative of it, and I am wishing you all happy holidays, Merry Christmas to you and your loved ones.
Well said, my friend. Well said. So I will add to, I want to thank all of our Premier and Plus members. And again, like Thomas says, those of you who have, found us in the last 6 weeks or a couple of months or so. It's been a really exciting year for us. We keep changing the format. We trying to bring a better product for you. And so I think, what we settled upon this year is that Thomas and I both want to present to you guys market opportunities. In other words, alpha. But we want to transcend from the buy, talking heads that you get on all these other channels. And we always give you that honest take in terms of reward versus risk. And so this year, we've had a share of winners and we've had a share of losers. And but you've always known where we stand with risk. Now, going into 2025, me as an investor, I see a lot of the same risks that I saw coming in 2024, as we are coming into a major change for the markets. But I'm optimistically or conservatively optimistic about what will happen next year. But the trader in me tells me that change is chaos, and chaos is just another word for opportunity. So I hope that you will continue to join us with our journey as we look for opportunities in the market.
Hey, John, I'm going to jump in real quick because we just got a question. Guys, the next show is going to be January 10th. So
yes.
not January 3rd. We're going to be off for the next 2 weeks for Christmas and New Year's. Let our minds get clear, and then we will be back with some awesome material on January 10th.
Yeah, again, waiting for that buy signal. So, with that, Thomas, I want to say from our family at Bar Chart to your family, I want to wish you all a happy holidays, Merry Christmas, and a happy and prosperous New Year. And until next year, the best of health, manage your risk, and the good of all trading.